Welcome to Economic Policy Institute's State of Working America Economic Briefing. EPI is the workers' think tank and for 40 years has been using the tools of economics to research and build policies for an economy that works for everyone, especially workers and their families. This is the first of what will be an at least quarterly webinar to address and digest all of these unprecedented economic times we find ourselves in, and also how it's impacting workers and working families today and how we expect it to in the future. Our moderator today is Chandra Childers. She is the Senior Policy and Economic Analyst with our EARN network. EARN stands for Economic Analysis and Research Network, and it's how we connect with organizations in the states and cities all around this country to help them use research to inform policy. Chandra uses an intersectional lens to research employment, earnings, job quality, and worker power, especially in the southern United States and all throughout the country. So you can see why is our moderator for today. So with that, I'm going to turn it over to you, Chandra. Take it away.
Thank you, Jen. Thank you so much. And thank all of you for joining us for this very important conversation about the state of our economy. In 2025, there were a number of policy changes that are deeply damaging to the long-term growth in the U.S. economy. These policy changes will increase income inequality, which is by far the biggest barrier to American families being able to afford a decent and secure life. This is true even if these policy changes did not lead directly to recession or accelerating inflation. Many of these changes exert a steady downward pull on growth, and they may not be have a particularly strong impact in any given year, but they will accumulate over time, and that makes us all much poorer in the long run. The risks in 2026 are much more in our face. The Iran conflict will absolutely send prices much higher if it continues, and it has greatly raised the risk of recession. In this webinar, we'll talk through many of these policy decisions and their expected effects on American families. Joining me to provide their expertise on these important issues are EPI's Chief Economist, Josh Bivens, and EPI Senior Economist, Ben Zipperer. Thank you both for joining me. Let me start with you, Josh. So we are through the first year of the Trump administration. Can you talk to us about the big picture on the policy changes that this administration has undertaken?
Yeah, I think it's useful to run through all the policy changes even before getting to the numbers because they've come kind of fast and furious. I would say the first thing to remember for context is that this second Trump administration inherited a very strong economy in terms of macroeconomic aggregates like unemployment and inflation, even stronger than the one they inherited in 2017. In that first term, in terms of macroeconomic policy, they mostly just surfed that pre-existing macroeconomic trend until the COVID pandemic hit. They did lots of policy stuff, lots of it I didn't like, but the macro policies were they were at least pretty modest, or they were at least pretty conventionally Republican, like tax cuts. They did a big corporate tax cut in the first term, undertook a lot of deregulation, but nothing that really was going to shove the economy hard off of that pre-existing macro trend that they inherited. This time, their policy changes have become much more quickly. They've become quite a bit more radical and almost all in a bad way, even for sort of macroeconomic outcomes. So like their tariff policy, it really feels like it was designed to foster as much uncertainty as possible and has ripped up pre-existing supply chains with no real strategy behind that would help other supply chains reform or help sources of domestic production get stood up. Immigration flows were falling rapidly, even in the last half of 2024, but they may well have gone negative in 2025. And if net immigration is somewhere around zero, this means the labor force is going to outright shrink in the coming decade. I'm not sure people have fully wrapped their head around that. The administration laid off 300,000 federal employees in its first year in almost entirely arbitrary ways. It was basically if Elon Musk read some person's tweet about a federal agency, that agency would be attacked. They passed a large tax cut, mostly tilted towards the rich, and they've baked in very large cuts to safety net programs like Medicaid and food stamps. They've also baked in large increases in student loan payments and have cut funding to research universities. And despite all these spending cuts, the tax cuts are expensive enough that they're still going to add measurably to the federal debt over the next decade. There are times when running larger deficits is fine or even good, say when the economy is really weak and needs an infusion of spending. That's not what they inherited. They inherited an economy that was strong in macroeconomic terms, did not need extra spending, and then loaded it up with a lot more debt to keep tax rates on the rich and corporations low. And then they undertook some of the largest acts of union busting in history in terms of trying to strip huge parts of the federal workforce of collective bargaining coverage. And they've really hamstrung the ability of the NLRB to protect private sector workers' rights to form unions. And finally, they have tried hard to capture the policymaking authority and the details of that of the Federal Reserve entirely within the White House. And then most impactfully, from a short-term macroeconomic perspective, along other angles too, is sort of the chosen conflict with Iran, which is generating huge ripple effects throughout the global economy, which US families are going to feel mostly as much higher oil, gas, and energy prices that push up overall inflation. We'll get a data read on that tomorrow. Sort of bad timing for this webinar. I can say a little bit more about that later. I'll just end though with all of these policy decisions. They're much more significant than what happened during the first term. They will all have pretty bad consequences. Some are short term, more of them are longer term, and almost all of these consequences are going to be bad for long run growth, particularly for typical American families. And that's the whole policy rundown. Oh, I think you're on mute, Chandra.
Of course, I'm on mute. Apologize for that. So that was the policy backdrop. So now, can you talk to us a little bit about some of the key economic outcomes of this first year, things that we should know about?
Yeah, I think running through a bunch of the relevant stuff, like in the last quarter of 2024, so the economy that was inherited by this administration, we had real GDP growth running at about 2.4%. In the last quarter of 2025, after a full year of its policies, that had decelerated a bit to a little under 2%. So you see some slowdown in growth. Inflation had fallen from 9 to 2.9% in the last 2 years of the Biden administration. So this very strong downward trend, sort of back to normality. That trend continued, but at a much slower pace in 2025. So basically, the administration inherited 2.9% inflation that was going down quickly. And 2025, it was still running about 2.5%. That's actually probably even artificially low due to some interrupted data collection from the shutdown. And it's about to leap due to the Iran conflict. So that sort of progress in reducing inflation had slowed a bit in 2025, and it's about to totally reverse. And then at EPI, we like to remind people that affordability is not just about prices, it's the outcome of a race between incomes and prices. And incomes, particularly wage incomes, didn't do great in 2025, mostly because the labor market cooled. In January 2025, unemployment was 4.0%. Now it's 4.3%. That doesn't seem terrible in the long run perspective of American history, but 4.3% means we are now sort of definitely drifting away from anything that you should be calling full employment. It is an unemployment rate that's not a disaster, it's not a recession level, but it's too high for most workers to really exert any meaningful leverage in the labor market. And you can see that probably because of this cooler labor market in 2025. Even with that modest slowdown in inflation in 2025, real wage growth adjusted for inflation for low wage workers actually went negative in 2025 after averaging 2.5% growth for the previous 5 years. So a very sharp swing to the negative for low wage workers. For median wage workers, real growth in 2025 was less than 1%, which was about half as fast as it had averaged over the previous 5 years. So that cooler labor market in 2025 that we already saw was really sapping income and wage growth for a lot of workers. All in all, if you knew nothing about the policy changes in 2025 and you were just handed this data, you'd probably be like, oh, that's okay. There's definitely some softer economic outcomes, but maybe nothing to panic about. I would argue instead it is kind of the tip of the iceberg of a bunch of bad policy choices that were already starting to drag on the economy in 2025. And it's all likely to hit much harder going forward, particularly with the effects of Iran.
Now, thinking about the lagged or delayed effect of this, can you say a little bit more about what the delayed effect of some of Trump's policies might be on economic outcomes as we move forward?
Yeah, I mean, I would say in terms of these delayed effects, you have to remember, a good analogy for the U.S. economy has been, it's like a cruise ship or a battleship. Turning it takes a while, even when you're trying really hard. And so you can have policy decisions that matter a lot, but take a while to have their sort of maximally bad effects. And so just one example, tariffs. Tariffs raise prices. That's mostly their point. This can be fine when they're employed for a real strategic reason. For example, if like imports are cheaper than US based production for some bad reason, like we have trading partners that don't respect labor rights, or they're competitively managing the value of their currency for competitive gain, or because they use more carbon intensive production techniques than we think should be limited due to climate change. Tariffs can be used as an incentive to make trading partners undertake better behavior and protect US workers in the meantime. But the Trump tariffs, I'd argue, don't have any real strategic purpose. And so instead, we're just going to get the price increases without much in the way of countervailing gain. And the research says that these price increases tend to take about a year to really start to be felt. Liberation Day was almost exactly a year ago. The tariffs that are in effect today are lower than what were announced on Liberation Day, but they're still quite high in sort of historical comparison. And I'll just note that a year of these high tariffs often defended on the grounds that they'd be good for US manufacturing workers. We saw 157,000 manufacturing jobs lost in 2025 relative to 2024. This is the most in the way of manufacturing losses since 2020, the year of the COVID recession. Ignore 2020, we'd see this was the most since the Great Recession of 2007 and 2010. And then ignore that recession, you see it'd be the most since 2004, basically some of the peak years of sort of the China shock that people know about that really helped decimate manufacturing. So in short, 2025 was unambiguously a very bad year for manufacturing. That was supposed to be the benefit of tariffs, building up manufacturing. Instead, the costs of them, which are the price increases, there are probably still lots of those in the pipeline. I'd say the damage done by cuts to the federal workforce on long run growth are going to be really significant. Those 300,000 jobs are a drag on the overall economy. They've probably outright caused a recession in Washington, D.C., but I think their real damage is going to be in the long run because the federal workforce is basically a really important input into production of the private sector. When the federal workforce can't do its job right because it's understaffed, it can't administer grants that support economy-wide research and development, can't regulate health and safety, it can't collect, analyze, disseminate data that businesses need to make good decisions, it can't surveil for risks in the weather and financial markets and potential supply chain disruptions. Basically, you're depriving the private sector of all of these useful public goods that are going to make them operate less efficiently over the coming years. And the downsides won't come in one single like monthly job report. They will just make us a less efficient economy over time. And finally, I'd say the budget deficits caused by the Republican mega tax and spending bill and the stepped up military spending, they're going to take a while to sort of meaningfully push up interest rates and inflation, but they very likely will unless we sort of enter a recession first. So there's, again, I think quite a bit of lagged pain in the pipeline coming from these policy decisions.
Thank you. That's a lot that is going on there. But we also know that in addition to those policies, tariffs, budget cuts, cuts to the federal workforce, that there's also been a major shift in immigration policy. And so, Ben, could you talk to us a little bit about the role of that immigration policy has played in the observed trends over the past year and what effects we could expect from it going forward?
Yeah, sure. So Josh mentioned a little bit about this, and as we all know, Trump has radically escalated immigration enforcement over the last year, increased deportations, arrests, detentions across the board. The administration has gone after not just undocumented immigrants, but also those with green cards, temporary statuses like parole and DACA, refugees and asylum seekers, and attempted to strip work permits from millions of workers. The first kind of major consequence of that is that these policies have rapidly shrunk both immigration, you know, to the to the U.S., as well as they've also shrunk the labor market. After a rapid increase in post-pandemic immigration, the number of new immigrants coming into the U.S. began to slow in the late 2024, and then it dropped very sharply in 2025 as the Trump administration forcibly removed people and more generally just made the U.S. less hospitable to immigrants. Trump's actions have had and will continue to have very large consequences for the size of the labor market. In contrast to prior years, immigration over the last year may have only added a couple of 100,000 people to the population. And at the same time, the US population is aging. The US born population, working age population between 20 and 64 is actually expected to shrink each year over the next decade. And so in the near term, immigration is actually the only way in which the US will increase the number of working age people. And we saw the consequences of this, the immediate consequences of this, very clearly in the monthly jobs data. Job growth fell by an order of magnitude in 2025. So in 2024, average monthly job growth was about 120,000 a month. In 2025, it was 10,000. What this means is that going forward, unless we change our immigration policy, we're going to have fewer workers. Businesses are going to have fewer customers. There are going to be fewer people starting businesses. Local areas that had growing communities due to immigrants could see their working populations shrink and their tax bases dwindle.
So sometimes we hear, for example, that these immigration policies that they're actually going to lead to greater opportunities for U.S. born workers, so that U.S. workers will actually benefit. Is there any truth to that?
No, there's not. It's just the opposite, actually. The US born unemployment rate is actually higher under Trump than it was in previous years. The claims that Trump and Vance made were basically one, immigrants are a bunch of criminals. And then two, they're stealing jobs from US born workers and making everything more expensive. Every bit of that is false. First of all, you see it very clearly in the arrest and deportation statistics that we have. When DHS and ICE surge into an area and arrest more immigrants, they mainly end up arresting people with no criminal records. And that's not really a surprise because immigrants come to the United States to work, to earn income, to provide for their families. Secondly, it's just a fantasy that deporting immigrants will benefit US born workers. Deportations do reduce the number of immigrant workers. That's true, but they also destroy productive relationships in our economy. When immigrants are arrested and deported, that means there are fewer roofers and framers to build the basic structure of homes. And research has found that when deportations cause construction to slow or not get started, there is simply less work available for US born electricians and plumbers. And because fewer homes are being built, housing gets more expensive. Other economic research shows that when immigrant childcare workers and cleaners are deported, US born mothers of young children end up working less because now they have increased care responsibilities at home. So not only can draconian immigration policy like we have right now, not only can it hurt employment, it can also push down wages. Immigrants are 1/5 of the US workforce. And so when you demonize them and increase their risk of arrest and deportation, you make their daily lives much more precarious and you make them afraid to look for better employment opportunities. And as a result, many immigrants will have to accept jobs with lower pay and worse working conditions. And that puts downward pressure on their wages, but it also puts downward pressure on other immigrants and US born workers working alongside them, making it hard for everyone to bargain for better conditions and pay. Research has found very clearly that when there is an increase in immigration enforcement, more deportations, more arrests, that reduces wages overall, and it increases labor law violations for all workers, both immigrants and the US born.
Great. So that's very helpful in thinking about the impact of this on the economy, on workers and wages. Another common factor in discussions about the economy is the role of AI. So where does AI fit into what's happening in the US economy over the past year? Can you talk about that a little?
Yeah, this is a very popular topic. I mean, the short answer right now is that AI is actually not directly affecting the labor market on a major scale, even in terms of changing the mix of jobs that are out there. Employer demand has really significantly weakened over the last year, but that's mostly about the tremendous amount of uncertainty and cuts implemented by the Trump administration that Josh talked about earlier, and also its aggressive increase in immigration enforcement. That doesn't have anything to do with AI. And in fact, Federal Reserve researchers have recently found that businesses with higher levels of AI adoption are not even reducing the number of job postings that they make relative to other firms. Now, what does that mean going forward? Well, the future is impossible to predict, but next month we will have an entire webinar on AI and about the policies needed to ensure employers don't exploit AI as a way to increase their leverage in the labor market over workers. However, there's one more thing I wanted to raise about AI, and that's that it really is playing a major role in keeping the economy afloat. Most of the Trump administration's decisions have been truly awful for business investment. And what I mean by business investment is stuff like building a factory, shopping center, producing equipment, hiring scientists to do R&D. Um, but at the same time, 2025 actually saw pretty decent business investment growth. And the reason why is that there was a big surge in AI related spending, like data centers and software. That played a huge role in supporting investment, also in supporting the stock market, which has made a lot of people much wealthier. And that has certainly boosted consumption. All of that AI related spending was probably about half of the total economic growth that we saw in the US over the last year. That is a very fragile base for growth. It's especially fragile because the stock market is clearly in a bubble. It's completely inconsistent with corporate profit projections. So I don't know when, I don't know how, but there will be a correction, and many companies' valuations will falter. Some of that investment will stop. Stock market wealth will contract, and the consumption boom attached to that rising wealth will stop. So while there are much harder, in some ways unknowable questions about what AI and the labor market is going to look like in the long run, in the short to medium run, we could really see a very unpleasant deterioration in the labor market caused by a quick evaporation of the economic activity that's now supported by AI.
Thank you.
I'm just going
That
to jump
is,
in for,
oh,
sorry,
go
one
right
second on
ahead.
that, just to
Absolutely.
add to everything Ben said. One way to think about it is that the timing of that capital expenditure from AI and the consumption spending out of the stock market bubble that Ben talked about that really came on in a big way in 2025 was really fortuitous for the Trump administration's economic record. Like I would argue many of the downsides of the policies that I was sort of talking about earlier would have had more visible effects in 2025 if they had not caught this wave of good luck of this just happened to be the year that AI spending really took off. And that was clearly happening before. Like we all know, ChatGPT rolled out in 2022. If you look at things like data centers, that investment was rising in 2023 and 2024. And they really just caught a very fortuitous trend in the short run in terms of all of this AI related spending that I think is masking some of the potential downsides of like the policy effects on macro outcomes.
Thank you for that, Josh. And since we have Josh, so earlier you mentioned the conflict with Iran. What can we expect in terms of the effect of this conflict on US economic outcomes in the next 6 to 12 months?
Yeah, I will say it's definitely the biggest question probably out there for the short run. I'm obviously not going to say anything about the moral or geostrategic angles of this, just the economic for now. There are times when like non-economists' gut feelings about the economic fallout from various events can be a little off. This is not one of those times. I think we all know what's going to happen. We've seen it already. We're going to see sharply higher prices, almost entirely driven by oil, gas, and energy stemming from the conflict. These high prices are going to lead to spending cutbacks, and this is going to slow overall growth. And this is going to put some upward pressure on unemployment rates in an already too cool labor market, which will in turn suppress wage growth even more. And then finally, if the conflict goes on long enough and it could really start rattling financial markets in a big way, maybe this becomes the pin that pops that AI bubble that Ben just mentioned in his last answer, which that would be essentially a recessionary event in and on its own. So it's going to reliably take a lot of money out of the pockets of typical families, and it's just going to very much raise the risk of recession over the next year. And then there's some non-trivial fiscal implications. And so just to give some numbers on all of this quickly, one, like the rule of thumb that links increases in the price of oil and overall inflation says that we've already likely baked in about a 1.5% increase in overall inflation over the next 6 to 12 months. We'll get the first read of that tomorrow. Probably the full effect won't show up in that March inflation report, but it will in the next couple of months. So basically, we're looking at inflation of at least 4% by the end of the year, maybe higher. If oil prices reach $150 a barrel, which seems totally possible if this continues, then this number would be more like a 3% increase in inflation, so something like 5.5% inflation by the end of the year. For the US, that's almost all going to be the oil price effect. It's not going to come through food. Other countries will have to worry a lot about food inflation for just weird regional reasons. We just don't have a lot of food imports that come through the affected areas. I will note, though, that grocery inflation was down to just over 1% for like the last 15 months of the Biden administration, but it already climbed back up to 3% in the first year of the Trump administration. That's a level substantially higher than we'd been seeing like pre-COVID or anything like that. I think that's mostly a story of tariffs and immigration-induced labor shortages. The Iran conflict won't add a ton to this grocery inflation, but it won't help, and that was already going the wrong direction. And then I'll just say, even the overall inflation increase that we've already baked in just through the oil price effects will probably force real wage growth for almost all workers negative over this year. Basically, real wage growth for most workers in 2025 was less than 1.5%. So if you do a sudden inflation shock of 1.5% due to a conflict, you're just going to shove all that negative. And then that lower real income stemming from that is going to harm spending. People are going to pull back on all sorts of spending, discretionary spending, and that's going to lead to probably an upward drift in the unemployment rate, probably hitting about 5% by the end of the year in some of the sort of worst case, not worst case, some of the not mild scenarios. And honestly, this has already gone on well over a month. We're out of the mild scenario in terms of the long run price effects. And then I'll just say one last thing, since I'm talking about unemployment and bringing that into the picture. It's worth noting something important, like our last inflationary outbreak caused by global crises was obviously like the early 2020s with the pandemic and the Russian invasion of Ukraine. This current shock is different in a couple ways. One, it was voluntarily chosen by the administration. It was not inflicted by external events. But there's another way it's different. And again, it's related to the fact that affordability is the outcome of a race between incomes and prices. If you can shore up income growth, you can actually keep affordability strong even when prices spike for a time. And in the early 2020s, largely because these price shocks were coming from external events and really you couldn't do much about them, the best policy course was to say, let's make the labor market as strong as possible to give US workers the ability to bargain for higher wages to insulate themselves against this coming price shock. And the Biden administration did that with the American Rescue Plan. They quickly engineered very low rates of unemployment that bolstered workers' leverage, and this worked. Wages weren't just insulated from inflation. Real wages adjusted for inflation for workers in the bottom half, they actually grew at their fastest rate ever, sort of following a recession. And this was a conscious, intentional strategy. The thought was this price shock is coming no matter what, so let's shore up the labor market, make it as strong as possible to cushion workers. That's not the strategy we're doing today. Like we're entering 2026 with a labor market that is already weakening pretty significantly. It's cool. And we've chosen this price shock just as we've also weakened workers' ability to get large wage increases. And so it's going to have sort of a double whammy effect on people's affordability. And then I'll just say one final thing on the fiscal costs. They're really big, even compared to the really big US federal budget. I see some estimates basically around 900 million to $1 billion per day in terms of the effect of this conflict. If you do a year of that, that's $330 billion about. It's more than 3 times the annual costs of the Medicaid and SNAP cuts that were included in the Republican sort of tax and spending mega bill, which is a pretty clear and pretty awful statement about priorities, and will have big economic effects going forward as well.
All right. Thank you. That was very, very helpful, both of you. Really good information. And I want us to now begin to address some of the questions from the chat. But before we move to the chat, I want to see if either of you had anything else you wanted to say at the moment, and then we'll move to some of the questions that we've got coming through in the chat.
I think we have a lot of questions. Let's move on.
Yeah, it looks like. So, okay, let's go ahead and get started with the questions from the audience.
So I don't know. I think I'll just pick one. I see a question about the K-shaped economy. So that's, if you're not familiar with the term, that's sort of a reference. It can mean a bunch of different things, but it's sort of a reference that there's kind of like two tracks in the economy, one for rich people and then one for everybody else. And some people are rich people mainly are benefiting from good jobs, good employment, lots of capital income, high stock prices, lots of wealth, and they are spending a lot of money, whereas other people, employment opportunities are scarce, wages are low, and they are not spending that much money. Those are kind of like the two tracks of the K. I would say that in terms of like the consumption kind of like angle of the K, the evidence that I've seen on that is pretty mixed. It definitely is true, however, that wealth has risen dramatically through the stock market, and that is certainly supporting a lot of consumption. And of course, the distribution of wealth in this country is I don't know if K is the right visual image, but it's certainly very unequal. I do think there is some like degree of truth to this K when we're talking about the labor market weakening. So as the labor market weakens, that the burden of a weaker labor market does not fall equally on all workers. Lower wage workers in particular, their options for alternative employment suddenly are more scarce or evaporate, and that dramatically holds down their wage growth at work. So when you see that unemployment rises as it is, low-end wage growth, like Josh talked about earlier, certainly starts to fall or not increase as rapidly. And it's also the case that low-wage workers are the ones that tend to suffer the most in terms of reduced employment opportunities, when unemployment rises, either generally or during a recession. So I think I would kind of pay more attention to that angle of the K, so to speak, going forward.
Okay, and Josh, go ahead.
Yeah, I mean, I see one in there that asks, what is the current state of the productivity pay gap and where do you see it heading in the age of AI? Just to remind or tell people, and the productivity pay gap is sort of a measure that we look at a lot in EPI, and it compares the hourly pay, including benefits, of typical workers, basically the 80% of workers who are not managers in the US economy, and we compare that to the increase in economy-wide productivity. Productivity is sort of the average output or income generated in an hour of work in the US economy. It's sort of the potential for everyone to get income increases. And then it looks at, are these income increases showing up as higher paychecks and benefits for typical workers, not just sort of really privileged ones? And there's been a big divergence between productivity and pay over the basically the post 1979 period. I would say the current state of the productivity pay gap, it's still pretty large. There's still a pretty big gap. We saw a period of time from like 2019 to 2024 where a lot of those typical workers actually got pretty good wage increases. because of the very tight labor markets, even accounting for the higher inflation. But we also had kind of a productivity boom during that time as well. And so we didn't close that gap too much. We basically saw both things rise. All else equal, that's not a disaster, but it does mean there's still a lot of room just for directing more money to typical workers. The economy has a lot more room to raise their living standards. Um, I would say a lot of that productivity increase from 2019, people are going to be tempted to say, is that AI? I actually don't think a lot of it is AI. It's in a lot of sort of industries that I don't tend to think of as being like big users or inventors of AI, like fast food restaurants saw very fast productivity increases after 2019. I think a lot of it was just the pressure of the very hot labor markets of 2021 and 2022 and 2023, where employers were like, it's getting really hard to attract and retain workers. They're demanding higher wages than we're used to paying, and we can't just find alternatives. And so it really does spur some investments and some productivity improvements. And that's the kind of virtuous cycle you want. You want high wages that chase productivity higher, that then support higher wages. And we had that for that period, but it didn't make the gap close that much. In terms of, going forward in time with AI, who knows? I would say I think some people think it's a given that AI is going to lead to a huge redistribution of money from workers to profits. I don't know that that's a given. Like if you look through past periods of time, when you look at really fast increases in productivity growth, episodes where we saw that, those have actually been episodes that have been pretty good for workers, not so bad. And so I don't think there's anything sort of baked in the cake for sure that says this has to be very, very bad for workers or the productivity pay gap. It certainly could be. Employers will try to make it so. And a lot of it's going to depend on what policymakers do to ensure that workers get their fair share of any income growth, regardless of whether it's AI driven or not.
So one question here is a comparison to other countries' economies. The EU's welfare state remains robust. India's leapfrogging the rest of the world in terms of green growth. So if we could just maybe do just a comparison to other countries.
Well, and I mean, I think maybe just building a little bit off what Josh was saying in terms of supporting workers in the age of AI. There are a lot of things that policymakers could do to provide better social benefits that would cushion any kind of disruption in the labor market, whether that's coming from AI or whether that's coming from, a stock bubble bursting or just a gradual weakening in the labor market. And this is sort of a solved problem in some abstract sense, and a lot of countries have, for example, nationally provided health insurance so that people's health insurance isn't, locked or they don't have to rely on an employment situation to guarantee good health insurance, or they have, a better unemployment insurance system. There's a lot that we could do in this country to improve unemployment insurance benefits, which help tremendously, of course, during a recession, but also in case there's, an increase in kind of frictional unemployment where people are taking, longer time in between jobs. So I think there are a lot of lessons from other countries, but a lot of things that we could apply to the United States to improve publicly provided benefits that would support workers throughout their employment cycle.
And I'll just add one or two things. I agree with all of that, obviously. And then in terms of like, I'm not an expert on like India's investment in green technologies for sure, but I know even in the US, as of just 15 months ago, we had some pretty significant investments and transition to renewables that were mostly trashed by the current administration in the Republican tax and spending bill. And when you drive around and you see gas prices at 450 and 550, you probably might think to yourself, it would be a good time to switch to an electric car. And just 15 months ago, you'd have gotten a pretty large subsidy from doing that because of the Inflation Reduction Act, and you will not today. And so I think in terms of learning from other countries, besides the sort of bigger social insurance and income support state, there's also just we don't talk about it much anymore over the past 15 months, but it remains a real imperative that we should transition away from fossil fuels as fast as we can in a sort of economic way. And we're really going to pay the price over the next year for not having some of those sort of green investments online as people try to navigate very high fossil fuel prices. And then I'll say one last thing in terms of like industrial policies. For an administration that talks a lot like they care about blue collar workers in manufacturing, I noted before the really dismal record of manufacturing job growth in 2025. And I think we're posting something today on our blog, which is basically a look back over a bunch of presidential administrations and talking about like what would really work to sort of grow the manufacturing sector in the United States and actually give it a chance to thrive in a competitive global economy. It is mostly about currency policy. And until we're really willing to really grasp that nettle, we're just going to have a smaller than optimal manufacturing sector. And so, yeah, I think there's just so much we could learn from other countries, but even from our own history, including a very recent history of just like 15 or 18 months ago.
There's also a question I see, why are states like Texas so reluctant to raise the minimum wage and address affordable housing? Um, I think this really gets to a key point that affordability, like we talked about and have others at EPI have talked about, is really connected to incomes. And when you're talking about incomes in the labor market, earnings from jobs that people work at, there are a lot of different ways to help with that. But there are basically kind of like three big ones. One is unions. They raise the pay of workers. Two, there's full employment, having a tight labor market, making sure that employers actually have to compete for workers, so that workers have a lot of leverage in the labor market. And then three, it's raising the minimum wage. And this is a real problem in the US economy. We're going on roughly 2 decades or about 2 decades since the last national minimum wage increase. And states like Texas and other states that still follow the federal guidance and don't have higher minimum wages, they are really kind of condemning many of workers at the low end of the labor market to suppressed and substandard wages that are completely out of date with the economic realities that those workers face. At the same time, there are a lot of states that have raised minimum wages, especially in places that you would not think that they would be as supportive of minimum wage policies. And that's because minimum wages are an incredibly popular tool and a very successful tool for raising wages. So you have states like, for example, Nebraska, Florida, Missouri, Arizona, places that are not, what you would call like the most liberal states in the world, actually raising their minimum wages, bypassing their state legislatures, which are the main obstacle to raising state minimum wages, and doing so through ballot proposals. And those have raised wages there, haven't solved all affordability problems, certainly, but certainly made a big dent in the affordability crisis that many workers face.
Okay, and the next question we have if incomes lag inflation, will that affect performance of housing, consumer, and student loan debt? And if so, what are the likely knock-on effects?
Yeah, like I think if we are in for a year where we've got these price shocks and then we also have slower income growth because the labor market is cooler, that's going to lead to lower real inflation adjusted incomes for a whole bunch of households. And if they have fixed costs, student debt, mortgage debt, something like that, that makes those ever more onerous to actually make those fixed costs. And some people will probably fall behind those. You see some measures, I think credit card delinquencies are up quite a bit over the past year and a half or so. And that definitely is an outcome of either a slowdown or an outright recession is you're going to see people falling further and further behind and some outright sort of defaulting on their sort of fixed debt payments. So yeah, I think that is a possibility. I see one question. It says, if possible, I would love to hear how this economy and recent changes are impacting the Black community in particular. I would say we know historically like if the overall unemployment rate rises 1 percentage point, that the black unemployment rate tends to rise about 1.7 percentage points. So based on that, you would say the overall unemployment rate is up, by some given amount, say 0.6% relative to its low point. So that should mean almost double an increase in the black unemployment rate. I'd say one thing that's been frustrating, we have some genuine experts on sort of labor market experiences by race at EPI. And one frustrating thing is our statistical sort of tools that measure unemployment rate, especially by demographics, they're starting to, I don't know if they're starting to get, they've always had too small a sample size to really say, I'm confident month to month in what the change in, say, the black unemployment rate is. Um, and it seemed particularly volatile over the past 6 to 8 months. Like at the end of 2025, looking at the published numbers, it really looked like, for example, that black women's unemployment rate was up a lot by the end of 2025. The past couple of months, it seems to have gone down a lot. I'm not sure if I believe totally 100% how much it went up and how much it's gone down. My strong guess is based on historical experiences that it has gone up quite a bit more than the overall average. But it really makes you think that we've seen this decline in response rates for our household surveys in our sort of federal statistical agencies over the past sort of couple of decades. Basically, we've also deprived BLS of the funding they would need to really do something to address that. We have incredibly smart people at these agencies who do the best they can with ever shrinking funding. And then add on top of that, 2025, just the outright attacks on the agency. The commissioner of the BLS was fired because the job numbers didn't make the administration look as good as they wanted to look. And so all this makes me, the summary of my answer is I wish we knew an answer to this with much more precision. And we could if we just made the investments in actually measuring the economy the way we should be making these investments. It would help everyone. It would help businesses. It would help people looking for jobs. It would help analysts. And yet we still have a far fuzzier take on that question than we should.
A large percentage of US GDP is from money spent by the top 5 or so% of income earners. What happens when they pull back on spending?
I mean, I can say one or two things, then maybe Ben will jump in. I would say we know that the top five or even top 1%, they have a hugely disproportionate share of total income in the United States. So basically, the top 1% has close to about 20% of the pre-tax income in the United States. Um, and they also have sort of a disproportionate share of total spending, but not that disproportionate because another thing rich people do is they save more money than everyone else. That is one of the privileges of being in the top 1% is you can save an ample amount of money. So I think I've seen some stats floating around that I think overstate a little bit how much of current consumption spending is concentrated among like the top 5 or 10%. Like I've seen some that say the top 10% are responsible for 50% of spending in the US economy. That just seems too high to me. I don't think that's quite true. That said, I think the stock market effects that Ben was talking about before, the fact that we have this big run up in the stock market and some people are using some of that increased wealth to support consumption spending, that is clearly happening. It's clearly mostly a story of the top 5 or 10%. And I do think if that stock market bubble does deflate really quickly, you will see a noticeable pullback in spending because people will no longer be like spending out of those wealth effects. And that's a real concern going forward. It is one of the many fragilities in our economy over the next year.
And yeah.
I see a question about the unemployment gap narrowing greatly between recent college grads and other workers. Why is that the case? Is AI driving that? Um, that's a good question. The short answer is that no, that doesn't have anything to do with AI. Um, the more longer answer is that basically, you are seeing some young workers without a college degree because the labor market is getting weaker. They are leaving the labor market and they are no longer part of the unemployment rate. So if you were to actually look at employment rates, like just the number of people employed divided by the population for young workers, whether they're college grads or whether they're not college grads, their employment trajectory over the last 2 years is pretty similar, and it's getting worse. Now, the reason it's getting worse is because employment demand is shrinking. The labor market has gotten weaker over the last year or two. And that affects young workers in two kind of ways. One, those are the workers that are kind of entering the labor market for the first time. So when hiring is down, that is the only way that they, become part of the labor market is by getting a job. So when hiring is down, they suffer a lot. They also have less experience, take lower wage jobs than say someone who is older, who has a lot of experience in the labor market. And because of that, those are the first jobs that tend to get cut or not. Employers tend to stop demanding when the labor market gets weaker. So they're kind of facing a little bit of a 1-2 punch right now. And that's mostly because the labor market is getting weaker. It's not really anything to do with artificial intelligence.
We have a question about the data. How reliable is data from the federal government, and what other sources are available for economic analysis?
You want to go ahead, Ben?
Yeah, sure. So in terms of like when you're hearing about like the Bureau of Labor Statistics reports the unemployment rate is 4.3% or something like that. That data is unbiased, accurate. There is no sense that it's being manipulated by the Trump administration. This is data that the economists at the Bureau of Labor Statistics pour over very carefully in very tightly controlled environments, and there is no sign whatsoever that this data is fake. I wish I could say that that's going to be the case forever, but the Trump administration is raising the real possibility that they obviously don't care about the truth or accuracy or the employees of the federal government. So that is something to be on the lookout for. I think we'll know very immediately if that is the case, just because we'll hear leaks from those agencies. But so far, the data is totally accurate. Accurate in the sense that it's not being manipulated. The main problem right now is that, like Josh was talking about earlier, a lot of government data comes from surveys. Those surveys have had falling response rates, both because it's just harder to do a survey now, and also because we have been starving those agencies of resources to actually improve those response rates and improve the quality of those surveys. That has taken, that's kind of like a long run problem that has suddenly gotten much, much worse with the Trump administration basically cutting agencies' budgets and making it extremely difficult for workers to do their job if they haven't been let go or forced out of their job in the first place. So this is a very serious and very real problem. It's clouding, just like Josh said earlier, clouding our ability to make simple determinations about like, well, what really is the unemployment rate for this group of workers this month? There's always some uncertainty about that, but the uncertainty has grown. And at the same time, this is in principle a very feasible problem to fix. We just need the political will and the funding to actually fix it.
And here I have two related questions. They get at the same thing. Is there data to show what percent of consumer growth is based on credit card debt? How much longer can consumers support shopping with debt? And are defaults growing? And then a second question is about monitoring levels of consumer debt and the percentage of delinquencies leading to property foreclosures, auto repossessions, and personal bankruptcies. And I can reread that. They just seem to be really connected there.
No, I think I would say in terms of the share of spending that is sort of debt dependent, it's a tough one to really pin an easy number on. Like on the aggregate level, like we still have a positive savings rate. And so economy wide, we have enough income to support the spending we're doing. Savings rate has fallen over the past couple of quarters. I think that's mostly rich people saving less, spending out of their wealth gains from the stock market bubble. Sort of low and moderate income people always have very low savings rates generally. Um, I think there's clear evidence that like the bottom half of families, especially in 2025, are starting to spend a little less and are feeling more stressed. We know their real wages for many of them declined. If you look at industries that rely heavily on sort of low and moderate income families like limited service restaurants, that real spending growth is very flat. And so I do think there's clear signs of pressure on those families, especially in the past 15 months. How much of that is linked directly to sort of credit card debt and the limits of that's a tough one for me to say for sure. I do think it's clear. These are the kind of families that sometimes have to rely on credit card debt just to support consumption, and that consumption is already under a lot of pressure. So I do think, there's definitely a story there that they all come together. But in terms of threats to aggregate growth, it's a little hard to pin a number on it.
Okay, it looks like we are out of time. And so I want to thank you both for your time and sharing your expertise with us. And I want to thank everyone for joining us for this conversation. And I will hand it back over to Jen to remind everyone to answer the questionnaire. Jen, sorry.
No problem, Chandra. Thank you so much for letting everyone know. We dropped the survey link in the chat. It also will come in the follow-up email. We appreciate everyone's questions. This is a lot of fodder for our next State of Working America economic briefing coming July 9th. Have a great afternoon and stay safe out there, everybody.